Good afternoon, ladies and gentlemen. My name is Adrian. I'm glad to be here in Vancouver again. I'm going to talk about, I'm going to talk about the royalty companies. I will be very brief in talking about what their advantages are, because I think everybody knows that. But we'll talk about some of the disadvantages of royalty companies, and I'll also look at how the royalty companies have performed relative to operating companies in bull markets. So, and we'll come to that, at the end. But first, let me, just talk about, or touch on rather, or refer to some of the problems in the mining business. And again, I think we've heard all of this about reserve depletion, the fact that there are very few discoveries, very few major discoveries being made, and the trend for the last 30 years has been downwards in the number of discoveries and the number of ounces found. And that's despite the fact that the industry globally has actually continued to put more and more money into exploration. So it's not that we're not finding stuff because we're not putting money into looking. And I think a lot of you know a lot of these things. In 2012, 13, 14, we could blame management for a lot of problems. But I think the truth is that mining is inherently a difficult business, even with the best operators in the world. I mentioned high costs there, and typically when the price of gold goes up, a lot of people will say, well, look, we've got a 20% margin or whatever at 1,400 gold. Just imagine when gold's at 1,600, we'll have a 40% margin. And it doesn't work that way. Because, of course, when the price of gold goes up, typically the price of other resources goes up. So the price of building mines goes up. The price of energy goes up. So the cost of running your mine goes up. And also typically what we call the resource currencies, like the Canadian dollar, Australian dollar, Brazilian real, South African rand, etc., they all appreciate typically when the price of gold goes up. And as the value of the resource currencies goes up, then the local costs of running a mine also go up. So the cost of labor, for example. So energy and labor are the two most significant input costs in running a mine, and they typically go up when the price of gold goes up. So as an example, let me just say, in 2004, when the price of gold was $400 an ounce, to 2007, when the price was $750 an ounce, almost a double, the margin on North American operators stayed static. It didn't move at all. And so anyway, we could go through all of these in detail, but the basic issue is that mining is a very difficult, inherently a difficult operation, and things tend to go wrong as well. Just to touch on one thing, I'm not going to show you the slide about the lack of discoveries, but just to look at the time from discoveries to production, how that has increased over time, partly, largely, because of increased time in permitting, because of environmental issues and concerns and NGOs and so on. And so it's not a surprise when you look at this, which shows you the return on equity of mining companies is a negative 3%. The return on equity is a negative 3%, and that compares with almost 16% for the market as a whole. In fact, over 50 years, half a century, the mining industry has eaten capital. It has lost capital, destroyed capital, rather than generated capital. And it's second only to the airline industry. So it is a difficult business, and it's no surprise that the stocks have done this. This is the XAU. You're Canadians, but I'm sure you all know what the XAU is. It's the Philadelphia Gold and Silver Mining Index for the major gold and silver stocks. And we are lower today than we were in 1986. So buy and hold hasn't exactly been a good strategy in the gold business. So what is the answer to this? I think one answer, or let's say part of the answer, is the royalty model for investors. And again, I think we're all familiar with the advantages of the royalty companies, so I'm not going to sort of belabor this. But royalty companies typically pay dividends relative to the gold ETFs. They have leverage to the gold price, just like the operators do. But of course, the gold ETFs don't. And they have exploration upside, which we'll talk about in a second, which ETFs don't. On the other hand, they don't have constant capital calls, they don't have operating costs, and they don't have environmental costs, which operators do. The other big benefit to the royalty companies, of course, is that they can have diversification. So you look at a company, the largest one, Franco. Franco has almost 40 revenue-generating mines, revenue-generating assets, and that is in a variety of jurisdictions with a variety of operators. So things can go wrong in a particular jurisdiction, things can go wrong with a particular company, but the diversification of a royalty business gives you a lot of, it negates a lot of those issues. Now, some companies are not as diversified as others. Wheaton, for example, has almost 40% of its NAV in Sloboda, the one asset. Royal Gold has about 27% in Mount Milligan, one asset. But nonetheless, it's a lot more diversified than most of the operating companies. One of the big benefits, one of the big advantages of a royalty model, of course, is the high profits. This is a slide of the XAU, the operating company's profit margins, and you can see that over this entire period, they've had losses, quarterly losses, as often as they've had quarterly profits. And the main reason for that is the margins. This is Franco-Nevada again. But even that dip down there, even at the low point, they still had a 60% profit margin. And the main reason for that, of course, is the low G&A. This is a slide of Franco-Nevada's G&A, and it's perhaps an illustration of you can make any point you want with a graphic, right? Because that looks as though the G&A is going up, and we don't know if that's a high or a low G&A. But here's the point. In 2010, at the beginning of this, Franco-Nevada had a 14% G&A. In 2019, relative to their market cap, relative to their revenue, sorry. In 2019, their G&A relative to cash flow was less than 8%. So in 10 years, although the G&A's gone up a lot, in 10 years, as a percent of cash flow is actually dropped by over 50%. And that's obviously a very, very low G&A. So debt is another issue. This is the XAU and the debt, and you can see that, yes, we've had significant reductions in debt from the peak in 2012-13, significant reductions in debt. But nonetheless, the debt of the operating companies is high, and it's a lot higher than it was in the early 2000s. And that's really a necessary factor of being an operating company. Operating companies have to have high debt. Royalty companies do not need debt. So this is, again, Franco-Nevada. I'm using Franco-Nevada because it's the largest of royalty companies. In their history, and in fact in their, this includes their sort of earlier incarnation before they merged with Newmont, And then subsequently they were spun out of Newmont again, as you know. So from 1985 to today, Franco-Nevada has had debt only twice in its entire history. And the first time they took on debt, which was to make a major acquisition, they paid it back out of cash flow in 1 quarter. Now they've got some debt. This was for the final payments on Cobre Panama. And I would suspect strongly, but by the end of this year, they will have paid that debt off. Now, I'm not saying necessarily that debt is absolutely wrong. Of course not. Especially if you're in a business that generates consistent cash flow, you could say that having some debt is actually a good idea. And that's the philosophy of a company like Wheaton, for example, one of the largest royalty and streaming companies. But Franco's philosophy has been to operate as much as possible without debt. And I guess the point I'm making is that being a royalty company enables you to operate without debt if you want to. And so as a result of all this, you can see that operating companies' cash flow has consistently, steadily gone down. This one's Newmont. Newmont and Barrick I pick on because they're the largest two, not for any other reason. And Franco-Nevada, the cash flow's gone up. Royal Gold, the cash flow's gone up. And I could pick all of the royalty companies, and you'll see how the cash from operations has gone up. Now, I mentioned at the beginning that there were disadvantages to the royalty streaming concept. And I think I've broken them down really into 4. In many ways, the most important disadvantage is that other people control the assets. So once a royalty or streaming company, and I'm using royalty and streaming interchangeably, okay? So once a royalty company has made a payment for a royalty, they're no longer in control of that asset. And we did have early on in the development of this industry, we did have issues with that, problems with that. I think most of you probably in this room know that the metals royalty business is a pretty new business. There's been a lot of public companies in the oil and gas space that have been royalty companies, of course. They've been around for many, many decades. There have been private royalties, of course, on mines, typically royalties that were given by the company to the owner of the land, and they were private companies. But as public vehicles that build royalty businesses, it's been really quite new from 1987, 1998. And as the business has developed, the companies have sort of learned things, and they've learned ways to mitigate the problems. So one of the problems, as I say, that others control the others control the assets. And, there's not an awful lot you can do about that. The second major problem has been that royalties can burden projects. And again, in the early days of royalties, we saw how that was a significant issue. Some companies would have 10% royalties, 15, even higher on a project, and they had acquired these royalties, and they were very happy that they now had a great royalty, until the company said, well, we're not going to put it into production because we don't make any money with that kind of royalty. And so, again, the royalty companies have learned, and you've seen many, many times how royalty companies, Franco, Wheaton, Royal Gold, have renegotiated the royalties with companies. An example would be Royal Gold renegotiated the royalty they had on Mount Milligan from a purely gold royalty, which was really burdening the project, into a combination gold and copper, spread it out over a longer period of time. But it did enable Centara to come in and buy the project and start the project. So companies can mitigate or can help with that issue by just being flexible. But the last two really refer to the companies as investments. People say to me, royalty companies don't have any leverage. What I often hear is, yeah, okay, Mr. Dave, they're great for bear markets, but in a bull market, you don't want to be invested in a royalty company because they don't have any leverage. And that is the one that is the easiest and the clearest to dispel. Typically, when a royalty streaming company buy a royalty or stream, they will also buy a royalty on the greenfields land around the mine site. So when we get a strong commodity market, whether it's a copper market or whether it's a gold market, and companies start doing greenfields exploration to expand their project, the royalty companies typically benefit from that to the same extent as they benefit from the royalty on existing mine. That is tremendous leverage because they don't put any more money in. You look at a company like Franco-Nevada, they have almost 400 royalties on their books. Some of them bought 20, 30 years ago. They will freely admit that they do not expect all of those mines to ever come into production. But think of a higher gold price and think of a company that puts a mine into production today where Franco has a royalty that they acquired 30 years ago, and this is a real case. They acquired it 30 years ago for a very small amount of money. They've never had to put another penny in over those 30 years, and then the mine gets put into production and they start generating revenue. I mean, I call that leverage. I don't know about you. So the mining companies have plenty of leverage in an up market. And if you look at the royalty companies, the royalty stocks rather, and you look at them, compare them with the operating companies, you find that other than in very short periods of time at the beginning of bull markets, the royalty companies tend to outperform as a group, they tend to outperform the operators as a group, even in bull markets over 1, 2, 3 year periods. So I guess I'm sounding like a missionary for the royalty companies, but I think they're the bedrock of a portfolio. Thank you very much.